Let's be honest, every investor out there has the exact same dream. We all want to buy stocks at the absolute perfect time. It's kind of the ultimate financial fantasy, right? We want to catch the market right at its lowest point and just ride it all the way up to the top. And because of this, there's this massive lingering fear of investing at an all-time high. People just sit back, look at the charts, and think, you know what, I'll just wait for the drop. But in this explainer, we're going to expose the cold mathematical reality of that exact strategy.
Which brings us to a really fundamental question. What if waiting for the perfect dip is actually making you lose money? Now, I know it sounds incredibly counterintuitive. Holding onto your cash, keeping it nice and safe while you wait for a crash, it feels perfectly logical. But in the real world of finance, this highly popular strategy has a bit of a dark side, one that is silently destroying long-term wealth. Section 1. The buy the dip illusion. See, our brains are basically hardwired to love discounts. If you want a new phone and you know there's a huge 50% off holiday sale coming up, well, waiting is absolutely the correct decision. And we naturally try to apply this exact same logic to the stock market. We think, I'll just wait until the Nifty goes on a 20% off sale. But here is the critical flaw with that. A retail store actually announces its sale dates. Out here, nobody can accurately predict when the stock market will hit bottom, or, honestly, if a crash is even coming at all.
And that leads to a massive paradigm shift. Money sitting idle is also making a financial decision. Too many people think that by keeping cash in a savings account, they're doing nothing. They think they're just safely pausing the game. But you aren't pausing the game. You are actively choosing to accept the invisible costs of sitting on the sidelines.
Section 2. Cost of idle cash.
While you sit in cash waiting for the sky to fall, the math is quietly working against you. First off, bull markets tend to continue much longer than expected. You might be waiting for a 10% drop, but the market could easily rally 40% before that ever happens. Second, inflation is a silent killer. Just think about this. A 6% inflation rate will literally have your purchasing power in about 12 years. Third, meaningful corrections take years to actually arrive, and that is years of lost compounding that you can never, ever get back.
Section 3. Nifty 50, SIP versus weigh-in. Let's look at the numbers. Historically, a disciplined index fund SIP in the Nifty 50 has generated roughly 10 to 12% annualized returns over long periods. And think about what that time frame includes. We're talking the 2008 financial crisis, the COVID crash, massive recessions, global wars. Despite terrifying macroeconomic events, simply staying disciplined and consistently buying yielded those historical returns. Let's put this reality side by side. The SIP investor, completely automated and emotionless. They just accumulate units in both high and low markets, quietly averaging out their cost. The dip investor, on the other hand, is usually a bundle of nerves. They're constantly checking the news, they're hesitant, and they are running on high stress. And the ultimate result? The SIP investor quietly builds a fortune, while the dip investor frequently misses out on massive multi-year rallies, just waiting for that absolute perfect entry point. So the crucial takeaway is right here. Compounding rewards time in the market way more than perfect timing attempts. Over a 10 or 20-year horizon, the sheer mathematical power of compounding basically bulldozes any minor advantages you might get from guessing a market bottom correctly. Plus, it saves you from a massive amount of emotional stress. Section 4. Psychology of real crashes. Because here is the harsh, on-the-ground reality. During a bull market, saying, I'll just buy the dip, feels super empowering. But an actual crash? It's terrifying. Your portfolio is bleeding red, the entire news cycle is dominated by catastrophic headlines about war, soaring inflation, or a looming recession. So what happens? The dip investor doesn't buy. They experience complete investor paralysis. The fear takes over, and suddenly they're too terrified to pull the trigger because they're absolutely convinced the market is going straight to zero.
Section 5. When timing actually works.
Now, opportunistic investing during a panic can be effective, but only if you have a strict foundation built first. First, you absolutely must already have an automated investing discipline running in the background. Second, a fully funded emergency fund is completely non-negotiable. You cannot invest rent money, period. Third, you need proper asset allocation. And fourth, long-term conviction. If and only if you have this safety net in place, deploying extra capital during peak fear can brilliantly complement your baseline wealth creation.
Section 6. Time beats perfect timing.
True wealth creation relies on consistency, patience, and emotional discipline. It's usually slow, highly repetitive, and honestly, pretty boring. It's not the sudden adrenaline rush of perfectly predicting a stock's bottom. But by automating your investments, you remove the temptation to time the market entirely. And as a bonus, you naturally curb unnecessary spending because the money is already invested before you can even touch it.
The market rewards disciplined investors more consistently than perfect predictors. It's time to let go of the illusion that you need to see the future. Abandon the stress of trying to time the absolute perfect dip. Set up your systems, stay consistent, and let time do the heavy lifting for you. So the real question is, are you willing to trade the fleeting excitement of prediction for the mathematical certainty of discipline? Keep learning, and I'll see you in the next explainer.